My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be my friends. I'm just trying to make you a little money. My job is not just to entertain, but to explain and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. We have stocks that are possibly headed to the moon, or maybe they're headed to the sun. That's what's become of this market. We have speculation all over the place, more than I have seen in ages. And I can't figure out whether it's the success of Bitcoin, the joy of hunting for the next Nvidia, or the widespread belief, rightly or wrongly, that Trump's second term means happy days are here again for all sorts of stocks, even the most risky and some would say flimsy of enterprises. I do know this. It's been a wild couple of weeks where a lot of stocks have soared with no reckoning whatsoever, including today, where the Dow gained 426 points to an all-time high. S&P climbed 0.35%, and the Nasdaq, which is lagged of late, advanced 0.16%. Can it continue? Well, isn't that the... Oh, my God. You look at how high things are. Why don't we do this? Let's go to the game plan. We'll do a little pondering, okay? Now, next week is historically just one hell of a week. Remember when you were, like, in high school and elementary school, whatever it was, and you would do this? Well, this fall doesn't allow you to do it. That's what you learned. Okay, Thanksgiving tends to unleash the animal spirits of the market in a very positive way. I'm no killjoy. I won't tell you to not buy buzzed or to designate someone in your family as the sober buyer. But there's getting to be a little too much speculation for me. And if we don't deal with it, if I don't talk about it, it's going to become a problem. I got to get ahead of it. With that in mind, what's happening on Monday? First, let's hope this Bitcoin takes out 100,000 already so we can stop talking about it. Long live Bitcoin, but this one's on the president-elect. And the idea of a strategic Bitcoin reserve, and all the people who justify buying it up here because they didn't own it any other way, below here. As long as it's legal, I'm all in. But understand, I have nothing to offer on Bitcoin's $100,000 price tag, nor does anybody else, by the way, except to say this. This is what happens when there are more buyers than sellers. How about stocks? All right, there's a heck of a lot going on. Retail earnings season continues on Monday with Bath and Body Works. These guys held e-commerce competitors much longer. They held them at bay much longer than other mall-based retailers. But the stock's been out of favor for a couple of years now. Believe it or not, the company's last two quarters have been okay. But both times, Bath & Body Works gave discouraging forward outlooks that crushed the stock. It's fallen from the low 50s at the end of May to around $30 now. Have expectations finally come down enough? If they can give us some positive commentary on the holidays, then it would go a long way in this market. After the close, we hear from Zoom Video, and this is one of those companies where the people who are shorting the stock are panicking right now, and the buyers smell blood in the water. Zoom's got a lot of irons in the fire, but it doesn't always seem like it has a lot of irons in the fire. This time, though, in this highly speculative market, it might finally matter if they beat by 2 or 3 pennies. Tuesday's a huge day for retail. In the morning alone, we've got Best Buy, Abercrombie & Fitch, Kohl's, Macy's, Burlington Stores, and Dick's Sporting Goods. Whew. Now, we've seen a bunch of retailers report not so hot numbers, yet in many cases, their stocks still roared. Meanwhile, others, like Target, get clubbed like baby seals. It's treacherous to start buying these now because many of these stocks have run mightily in the last few days. Take Dick's Sporting Goods. Now, this one jumped 8 points just today. Is that good because it's a sign that numbers will be great, or is it bad because it's borrowed upside? I'm betting it's actually the former, because Dick's is a category killer, and there aren't that many of these left. Williams-Sonoma comes to mind. I think Dick's can pull it off. But is Best Buy still a category killer? We trimmed some of our position for the Chapel Trust this week after a big gain because we listened to the home repair tales of woe that we got from Home Depot and Lowe's. This one is what I call too fraught. Then again, the shorts are on the run, and no one really expects much from Best Buy. So if it gives us anything good at all, then it's to the moon Corey. That's Corey Barry, the CEO of Best Buy. Man, how old do you have to be to get that honeymooners reference? The Hills are now younger than I am. Abercrombie bombed last quarter. After listening to the success that is Gap last night, I don't think that A&F gets it wrong twice. They're too good for that. Kohl's, let's just say guilty until proven innocent. Let's hear what they have to say about Sephora, which I think is the main reason to go to the store now that Kohl's cash seems to have lost its allure like Confederate dollars. Next up, Tony Spring, the CEO of Macy's, knows that his chain makes an incredible amount of money in the next 30 days. This quarter is simply a prelude to Macy's season. If he can tell a good story about the Bloomingdaleization of the chain, that's Bloomingdaleization, I guess, really, then his stock will build on today's lead. I mentioned that because Tony is from Bloomingdale's, and he did such a great job there, and I am pulling for this guy. TJX and Ross Stores both reported good numbers, and I doubt that Burlington Stores will be any different. Well, that makes for a terrific trade. We have a food stock reporting, too. J.M. Smucker. Let me talk about this. The market doesn't seem to like the food stocks anymore, does it? But maybe they're, at this point, overly hated? Wall Street doesn't like that Smucker seemingly paid too much for Hostess Brands when it shelled out $5.6 billion for the property that's known as the king of junk food. But in this market, if Smucker can simply deliver inline numbers, the stock could soar because of all those Twinkie bashers who would be caught leaning the wrong way. In other words, shorting the stock when they shouldn't be. After the close, we have some big tech names reporting, including some that we own for Travel Trust, CrowdStrike, Dell Technologies, Workday. I think we might see these go 3-4-3. CrowdStrike's been on a charm offensive, that's George Kurtz. Ever since that summer glitch heard around the world, I believe that CEO Kurtz has a free pass to say how the company's doing. So it might be a real good time to buy it ahead of the quarter. Maybe pick some up this day. Palo Alto, by the way, it also did well yesterday. People didn't get it. The quarter was 2 days ago. The quarter was actually very good. OK, my Travel Trust owns both, and it's worth going over our investing bulletin on the quarter that is Palo Alto, so you actually know what happens versus what the stock is saying, because the stock is wrong. Dell is the best partner of Nvidia when it comes to implementation of Blackwell, which is the new generation of AI chips. I buy some now, and then I buy some after it pulls back. And hey, if the stock doesn't come in after it, well, then you still got a good position on. I am a huge believer in Michael Dell, and I think we're lucky to be able to invest alongside him. Workday. Easy. It's enterprise software, and suddenly the world loves enterprise software as much as they hated enterprise software earlier in the year. Workday was there early. It's a winner in the human resources and financial spaces within the enterprise. Now, here's a really important one. After the close, HP reports, and I want to know the truth here. If the AI PC is really doing as well as expected, then I don't think it is. And I think it might not be. And we need to know why. Here's a question. Is Microsoft's Copilot a useless appendage like Clippy? You know that Mark Benioff thinks so. He's been talking about it for ages on Twitter. You ought to check it out. I say truth is wanted here. I wish there was more to say. Stocks have historically been a done deal after Tuesday. But we do have a key Fed number, the personal consumption expenditure, PCE. Now, we know the economy's been running hotter than the Fed would like. There's talk that we have no need for December rate cut. It's a very tough call, especially because long-term rates, including mortgage rates, have been climbing since the Fed started cutting. You know, it's supposed to go the other way. So a cool PCE number could cause still one more eruption higher. A hot one, though, we might see a rollback in some of the most speculative stocks. That's what I'm concerned about going into the weekend, bottom line. If you have huge profits in the month of November, could you do me a favor? I would show little thanks next week and take something off the table in your most risky positions. You and I will certainly feel better about it later on. How about we go to Suzy in California? Suzy.
I'm Suzy here. I don't know you said my name. Hey, I love watching this show and all the fun you seem to have punching those buttons and talking stocks. Electricity and power generation through a variety of segments, retail, Texas, East, West, and asset closure. It's had a great run since August 2023 from 28 to 162. In fact, when I first heard you talk about the stock in September, it was 112, but I didn't buy it as I knew nothing about the sector. What do you like about Vistra? And what tells you to be a good investment?
Okay, so let's say you listen to it. Thank you for that, Suzy. If you're looking at, if you went over Nvidia's call yesterday, there's a part where Jensen says, listen, the CEO, we just don't have enough power in this country to handle all these chips. And people say, okay, well, who does? And the one that always comes to mind is Vistra. So every time somebody says something good, there are buyers who come in and buy Vistra. At this point, Suzy, I'm going to say heresy. I'm going to say enough. Let's let this one come in. Or more importantly, let it go up now without me. I don't want to continue to support something that is up this much because I have to worry about what happens now when it goes down. I need to speak to Randall in North Carolina. Randall.
Booyah, Jim. I have two items here. First,
okay.
I would like to thank you for bringing my attention to Nvidia a while back. It's been very positive. And in honor of that, I want to name my next dog Cramer. Second.
Holy cow. I mean, I would love that. But remember, it's not the Cramer from Seinfeld. It's the actual Cramer. Okay, go ahead.
Got it. Second, how do you see the possible turnaround of Boeing stock BA? I've got some statistics here. You know, it's supposed to be profitable in 2025.
Right.
Orders are coming in. They lost $6 billion in the third quarter. The 737 MAX.
Okay, I'm pulling for Kelly Ortberg. I'm pulling for Kelly. I think that they can get. I mean, he gave a pretty encouraging talk, I felt, this week, but it was also very sober. But you know what I have to say? I say, why do we need to worry about the entry point in Boeing when we can just stay with Nvidia? And I talked to another Nvidia millionaire yesterday, someone who watched the show and just became a millionaire from Nvidia. It's Jensen that's doing it. We just talk about the news. The market's been a great run here. And if you have some big profits, you know what, from this month? I'm actually now begging. I would get on my hands and knees, but I'm really tired. Take something off the table, please. All Mad Money tonight. Could the natural gas industry be a Trump trade to watch? I'm telling you where I stand and give you some stocks to keep on your radar. Then as earnings season winds down, I'm recapping the latest retail reports, sharing my takeaways about the state of the consumer. And later, I'm taking Cramerican calls as we play MI Diversified. So make sure your portfolio is positioned even in a market where it just seems like nothing ever goes down. So stay with Cramer. In the 2.5 weeks since the election, all sorts of Trump trades have caught fire. Everything crypto's up huge. Bitcoin's up 43%, Coinbase up 57%. Private prison stocks are soaring 69%. And of course, Elon Musk's Tesla is up 40%. Buy! And hey, maybe they keep running, but honestly, many of these knee-jerk reactions seem pretty extreme to me. So tonight, I want to give you what I think is a more sustainable Trump trade. I'm betting the whole natural gas ecosystem will thrive with the Republican trifecta in Washington. Our country is blessed with abundant quantities of natural gas, which can be produced on the cheap. Some people think we're the lowest in the world. But thanks to the Biden administration's antagonistic attitude toward fossil fuels, along with the weaker global economy, the nat gas complex has underperformed for most of the year. I think that's about to change. See, while we've got tremendous amounts of natural gas, we don't have the infrastructure to get it where it needs to go. In part because the Biden White House loves blocking new pipelines and even declared a pause on new liquefied natural gas export authorizations. That was a stunning comeuppance, by the way, to one of our strongest industries that employs thousands of people in high-paying jobs. The betting is that Trump's going to undo that on day one, giving new life to all these LNG projects that really have been stuck in limbo. A lot of them canceled, by the way. We already know that Trump has appointed an oil exec as energy secretary, Liberty Energy's Chris Wright. And this guy makes Exxon or Chevron look like Greenpeace. He's going to give the industry everything it wants and then some. I think he'd drill in a schoolyard when they are playing dodgeball. Now, since the election, natural gas itself has spiked more than 17%, although much of that's thanks to a recent cold snap after a warm fall and a generally late start to winter. Seasonally, this is a good time for the commodity, but I also think that there's some optimism about the future of the industry driving this move. So if Trump's going to give the natural gas industry whatever it needs, what's the best way to play this? First, you could own some producers. Now, I happen to like a company called EQT, which is exclusively focused on natural gas, operations in the Appalachian Basin across Pennsylvania, West Virginia, Ohio. After spending a couple years trading sideways, EQT's caught fire since the election, climbing 22% to its highest level since late 2022. Even before the election, the stock was getting some buzz. Bank of America reinstituted coverage with a buy rating in late October. Then the next day, EQT reported a terrific beat and raise quarter, which did shock me. Earlier this year, EQT made a pipeline acquisition, buying Equitrans, all-stock deal, valued the company, combined company at more than $35 billion. That closed in July. In the latest conference call, EQT CEO Toby Rice, a real smart fellow on our network a lot, was ebullient about the merger, saying, and I'm going to quote it, transformed EQT into America's only large-scale vertically integrated natural gas business, end quote, and true, before noting that the integration is well underway, and saying that all sorts of efficiencies are being unlocked along the way. If the natural gas rally truly has legs, then I got to tell you, EQT, bye-bye. By the way, I still very much like Coterra Energy, currently the only energy holding in my charitable trust, which, of course, you can follow by joining the CNBC Investing Club. This is another exploration and production play, although it's more balanced between oil and gas. In fact, after a pair of acquisitions announced earlier this month, Coterra's revenue mix will tip a bit more in favor of oil. Next year, we like to say it's more oily, less gassy. It does happen to have the lowest cost natural gas of any company in our country, and that's because of the legacy of the old Cabot Oil and Gas, which created Coterra when it merged with Cimarex and rebranded the combined company. I like Coterra Energy because it's one of the shrewdest operators in the industry. I trust them to handle whatever environment we already have, making it a great long-term holding. When reported late last month, Coterra announced that they'd signed 3 new liquefied natural gas supply agreements to sell a total of 200 million cubic feet per day, indexed to international price points. Now, that's huge because international price points are much, much higher than domestic ones. The actual sales won't take place until 2027, 2028. That was a bummer to me. But it's the nice, look, they're going to unlock a lot of demand, and I think it gives it a great glide path for the next couple of years. When we spoke to Coterra's CEO, Tom Jordan, a couple of weeks ago, he told us that there's, quote, there's more of that to do. And you know what that meant? That meant be patient. He's going to do some more deals, but no deals that aren't accretive. Other than the producers, what works if you're betting on a natural gas renaissance under Trump? I do that as a pan to Will Frost. How about a pure play on pipelines? Much easier to build these under a Republican administration. There are plenty of good options here. I've been consistently bullish on Energy Transfer and Kinder Morgan. They yield 6.8% and 4.0% respectively. But rather than those two, I actually want to pound the table on one that I think it's getting a little support, but it's not like it's called Enbridge. We've had them on air. The Canadian company that transports nearly 20% of the natural gas consumed in the U.S. and also operates North America's largest natural gas utility. By volume at least, serving customers in Ontario, Northeast Ohio, Utah, and North Carolina. For the pipeline business, the company is very strategically located, assets connecting to the Gulf Coast to the eastern Midwest, meaning the Appalachian Basin. They actually are in the Gulf King, okay? They also go across the Northeast. They can get natural gas where it needs to go. Their system is just incredible. After spending a long time, I mean like a super long time in the doghouse, Enbridge has taken off in the back half of the year, rallying 22% since the end of June. Even after that move, though, the stock sports a bountiful 6.1% yield. It's one of the safest dividends around, totally covered by the cash flow. We've been with it the whole way for years now, and have been able to get that juicy yield while waiting for what some thought was Godot, but it turned out to be Trump. That was not bad. Finally, with a new, more fossil fuel-friendly administration coming in, I think it's time to start thinking about the direct liquefied natural gas export plays. Again, we've liked them for a long time. Probably we were the first to like them in the whole country. And the best play is the one we first recommended, which is Cheniere Energy. They were a first mover and have a nice lead when it comes to nat gas exports actually happening right now. The stock trades sideways from the mid-2022 until the middle of this year, but it's gained a mere 15%, any way you want to look at it, since the election reached new all-time highs. I also like Sempra, which is a more diversified power company, but has plenty of nat gas exposure through regulated gas utilities in California. Big nat gas pipeline network that helps bring gas to Mexico. Can you believe that they need our natural gas after being so big in it, but they haven't done any of the infrastructure? It's also got a growing portfolio of LNG export facilities in both the U.S. and Mexico. This is another name that's broken out since the election, straight up actually, also up 15%. Now, I would be a little more cautious. I'd buy some and then wait for it to come down. But here's the bottom line. We're hearing about all sorts of Trump trades right now, and many of these things have made insane moves in less than 3 weeks, to the point where actually they're feeling a little precarious to me. If you want a sustainable Trump trade, I say bet on the natural gas ecosystem. This is an industry that already had a lot going for it. It just needed some cooperation from the federal government, which is about to get. And that's why I can get behind producers like EQT and Coterra, pipeline plays like Enbridge, liquefied natural gas export stock like Cheniere Energy and Sempra. I bet they keep running for the next couple of years, not months. They have all moved, but they are nowhere versus where they could go now that the Biden's anti-fossil fuel team has been broomed for one that is totally supportive of this industry. Mad Money's back after the break. After Nvidia reported on Wednesday night, it felt like we finished that 26 mile of the earnings marathon that started all the way back on October 11th when the Chiefs were still undefeated. And we didn't even know who the next president would be. But earnings season is about more than the Magnificent Seven. And a marathon's not over at 26 miles. It's got 26.2 miles long. That's why tonight I want to walk you through the last fifth of a mile, recapping some of the big retailers that reported this week. After all, as much as I love Nvidia, and you know I do, demand for AI chips doesn't tell you much about the state of the consumer. First up, Target, which reported a quarter that reminded me of those videos of deep-fried turkey fires we always get this time of year. Honestly, I mean, that comparison does a disservice to backyard grease fires. Target missed the mark on basically every important line item. Their 0.3% same-store sales growth came in well below the 1.5% that the analysts expected, and it showed decelerating traffic from the previous quarter. Overall sales came in light too, and Target had their worst profit miss in 2 years. With the exception of beauty, okay, which is handled, by the way, by Ulta, discretionary spending exhibited softer sales trends compared to the previous quarter. As a result, management was forced to lower their full-year earnings per share forecast by 75 cents at the midpoint. While management noted that port strikes drove some additional costs of the quarter, that wasn't enough to prevent the stock from tumbling nearly 22% the next day. It's not the numbers alone that caused the decline. What really worries people is that Target might be losing market share to the competition because some of its competitors offer much better bargains. Competitors like Walmart, which reported a stellar quarter just 1 day before Target, and what a difference 1 day makes. So Walmart absolutely crushed the estimates with a 5.5% same-store sales growth compared to 3.9% consensus, including some very impressive numbers from Sam's Club. In complete contrast to Target, Walmart gave you a terrific top and bottom line beat, then raised their full-year forecast. Walmart's management called out several different areas where they keep gaining market share. No wonder everybody sold Target when it missed the next day. Just as management noted that 75% of these share gains came from households earning at least six figures. Nobody ever got hurt by having customers who too rich, and this wealthier cohort, by the way, is relatively new to the Bentonville Colossus. General merchandise also posted the first year-over-year growth in 7 quarters, and that's despite prices coming down over 4%. Turns out that when you give people great deals, you can make it up in volume. Management expects these market share gains will continue in the fourth quarter, which is why I think the stock kept climbing all week. And hey, it's not hard to understand why people are flocking to Walmart. 6,000 price rollbacks, 6,000 across all categories last quarter. Doesn't matter if your household's making hundreds of thousands of dollars a year. Value is value. And besides, according to the Bureau of Labor Statistics, 100 grand today is equal to about 80 grand the year before the pandemic. Easy come, easy go. Like I keep saying, Americans are just sick and tired of high prices. The few retailers and restaurants that are willing to offer great values are making fortunes here. The ones that keep their prices high are being eaten alive. How about the rest of retail? Williams-Sonoma, another company that delivered a surprisingly great quarter, thanks in part to their value proposition. Now, we had President and CEO Laura Albert on the show earlier this week. She was fantastic. She explained how the price-to-value balance has brought customers in while allowing the company to significantly reduce their promotional activity, helping them deliver these blowout numbers. Boy, she really railed against the people who do a lot of promotions. That's not her game. Hey, speaking of value, how about TJX, the parent company of TJ Maxx, Marshalls, Home Goods, which we own for the Travel Trust? This is an off-price play. They buy excess inventory from normal retailers for chump change. They mark it up. And remember, these are retailers that got to get rid of the stuff because they got the new stuff coming in. And they give it to you at a great price. So I wasn't surprised that TJX reported a comfortable top and bottom line beat, healthy same-store sales growth in all key operating segments driven by higher transactions. Now, the conference call was even more encouraging. Although flat, it was encouraging. CEO Ernie Herrmann, non-promotional to say the least, said, quote, "We continue to see outstanding availability of goods across a wide range of brands, which gives us great confidence in flowing fresh, exciting assortments to our stores and online this holiday season and beyond," end quote. Despite the impressive results for the quarter and encouraging commentary, the stock barely budged. At one point, it was down a couple of smackers, partly because the guidance looked a little light. But as someone who has followed this stock for ages and knows it well from our Travel Trust, I can tell you they are serial performers of UPOD. They underpromise and overdeliver, and boy, do they ever overdeliver the next quarter. Next, just like Walmart and Target, it had wildly different results in basically the same space. How about Lowe's and Home Depot? They went in totally different directions. Last week, the Despot reported a top and bottom line beat, strong same-store sales growth, so people expected good things from Lowe's before it reported on Tuesday morning. While Lowe's did beat the estimates for both sales and earnings, the stock had already rallied to the point where there just wasn't enough. Unfortunately, because Lowe's has a higher mix of do-it-yourself customers compared to Home Depot's more professional customer base, Lowe's has been hit by the continued pressure on discretionary spending in general and the home improvement industry in particular, renovation, okay? This gap would have been even more pronounced if it wasn't for the sales benefit they saw from the hurricanes. Still, Lowe's sees a benefit when the home improvement cycle starts or turns when the Fed keeps cutting rates. Hopefully, they got an analyst. You remember, they had an analyst meeting come up December 11th. I think Lowe's is going to tell a very powerful story. If management can make a compelling case, and I think they can, for why the business might improve towards the beginning of next year. We own Home Depot for the Travel Trust. It was just better, but they really are the professional place to do home renovation and construction. To close out this week of retail, last night, oh, what a joyous call. We heard from Gap. which also owns Old Navy and Banana Republic. I've been a big fan of what CEO Richard Dixon's done to turn things around here with his focus on reinvigorating the brand. And last night's results show that he's pulling it off. Despite posting slightly softer than expected same-store sales, the Gap managed to deliver a modest revenue beat with much better than expected margins, leading to an impressive 14-cent earnings beat off a 58-cent basis. Wow. As a result, management was able to raise their full-year forecast. Most promising of all, Gap's brands gained market share in the quarter. That's huge. Each one did. It was great in the conference. You got to go listen to it. Plus, it's athleisure nameplate, Athletica, it inflected much earlier than I thought it could. Athletic, can you imagine these guys, Athleta? Athleta's probably missed the quarter for, I think that's all they do is miss the quarter. It's no wonder that the stock rallied 12%. By the way, the commentary from Richard was really, really strong about each division. Here's the bottom line. Now that we've worked through retail week, it's safe to say that the earnings season marathon has come to an end, except for a few stragglers that I mentioned at the beginning of the show, and we can spend the next week gobbling on turkey and some sides instead of quarterly reports. I'm going to have to go to Athleta and get some clothes that'll fit me by the end of next week because I haven't eaten in days. True. Trey in Texas. Trey.
Jim, my wife's been telling me she's tired of me prioritizing watching Mad Money over our marriage as she sees it.
Why, Trey? You and I both know. We talk to each other more than I talk to my wife. I got to tell you. My wife is jealous of Trey. She is. She says, why do you keep talking to Trey? What is that special relationship? I say, it's okay. It's okay. He's in Texas. All right, go ahead, Trey.
Mine is, too. In fact, earlier this week, she went as far as to tell me if I ever call into the show again, she'll leave me. Anyways, Lululemon Athletic.
My wife's saying the same thing if I take your call. All right.
Absolutely.
I'm sorry.
Yeah, I was just saying, Lululemon. Now, I bought this back in January, so naturally it's down about 40% year to date due to rising comps, falling margins. Am I safe holding on here, or should we separate?
I want you to buy Gap. This Athleta division was up 5%. It's rather extraordinary. I think they're going to start taking share from Lulu, and I'm very worried that Lulu became so China-centric. And you know what I think about China? Fugazis! All right, now that we're here nearing the end of retail earnings, we're seeing some clear winners like Walmart and Williams-Sonoma merge with Pack. And don't forget Home Depot, because they offer real value to the customers. And there's so much more mad money, including Am I Diversified? Then, with stocks like Rocket Lab, Ben Stoto, favored by, he's our chief engineer, also research director, surging higher. Should you be confident in or cautious of the long-term outlook? And I am joking. I'm laying out my keys to a bit about that he loves the stock. I'm laying out the types of moves that you can expect. And all your calls rapid fire, and tonight's just in the lightning round. So stay with Cramer. We love the major averages. They all finished the week higher. Dow closing at a record high. Can you believe it? But, we're also seeing some sector rotation happening under the surface. It's pretty vicious. So I got to make sure your portfolio is positioned to take advantage of it, not just be beaten by it. And that's why tonight we're playing MI Diversified. This is where you call me and tell me your top 5 holdings. Tell you maybe you got to shake it up a little, or maybe you can keep it the same. Let's start with Brian in Sweet Home, Alabama. Brian.
Hi, Jim. How are you?
I'm doing real well, Brian, because it's Friday. How you doing?
I'm good. Hey, Jim, I wanted to thank you. First of all, I wanted to thank you for all that you do and to say I've benefited greatly from your advice, teachings, and investment disciplines and the wealth of information that is available online to members of the CNB Investment Club.
Oh, man, you're terrific, Brian. Thank you. You are terrific for saying that. Thank you.
Well, Jim, you are the Pied Piper of Wall Street, bringing common sense investing advice to the masses, and thank you, my friend.
Well, we're all part of the masses. Maybe that's what it takes to recognize you and I are in the same boat. And it's not leaky, it's strong. Let's go to work.
Let's go to work. So, Jim, as an engineer, I'm a big believer in the technology sector. So if you would, please evaluate the diversification of my 5 stocks from that perspective. Basically, what I've done is I've created my own technology spider. And since 2016, it's up 360%. And I do understand the risk of concentrating in a sector. So I want you to know that I have not put all of my eggs in that basket, a significant amount. But I think with today's market and with AI and so forth and technology, I think it's well worth the risk.
Okay, so I see what you're talking about. I'm going to evaluate it with that in mind. I'm not going to just say, hey, it's all tech, forget about it. I understand exactly where you're going. Give me the names.
Okay, look, my 5 stocks are Nvidia, Amazon, Broadcom, Palo Alto Network, and Microsoft. Thank you, my friend.
No problem. There they are. Okay, isn't that amazing? There they are. Okay, so let's think this through, because what Brian is basically saying is, look, within the confines of the 27% of the S&P that is technology, there are enough rivulets within technology that we should be able to explore each tributary. So let's do that. Palo Alto Networks is a club name that is one of the finest cybersecurity companies. It was a good quarter, but there are knuckleheads who think it wasn't, and they'll be left behind. I don't mind. See you later. Don't let the door hit you on the way out. Broadcom is very good plumbing on the inside of cell phone, inside of data center, inside of the server. It's pretty much everywhere. It's ubiquitous, so we understand that. Amazon is primarily now a web service company that also has a retailer connected to it and also has an advertising business. Nvidia, we now have to be able to say, is the backbone of the whole darn world because it's an industrial revolution that's occurring. And Microsoft, we're going to say, is enterprise software and gaming. So we have enterprise software. We have a web service company. These both have web services, but they also have ancillary companies. Why don't we do this? We won't consider this web. We won't consider the cloud business per se. We will consider only their other business, not ancillary. So this is going to be software. This is going to be retail. This is plumbing. This is cyber, and this is Internet of Everything. I don't know how else to put it. And in that sense, Brian's got himself a terrific portfolio. What would I have done differently? Broadcom is not the semiconductor company I would have used. I would have used AMD, and he knows that, but AMD doesn't act well right now. But I think this is going to do just fine. We're going to stay in Alabama, frankly, because it happens to be one of my favorite states. Let's go to Jimmy in Alabama. Jimmy.
Hey, Jim, this is Jimmy. Thank you for your time. I became an investment club member just a few months ago. One of the first things I learned from you was don't invest more than 5% in any one individual stock. Well, I first started buying individual stocks in 2015. One of the first I bought was Nvidia. I've since sold my initial stake in it, but now of my 20 stocks that I own, 60% of the total composition is really Nvidia. So what do I do? I have 5 stocks to talk to you about.
Okay. Well, first I'm going to say that's one of the highest quality problems. But because you took if you've taken your cost basis out, all in all my books, I say once you've taken the cost basis out, you let it run. I don't care that it's that big a position. Nvidia, but I don't know the other stocks. Let's see where the other stocks you have.
Okay. The other 4 stocks that I have are Cortera Energy, Intuitive Surgical, J.P. Morgan Chase, and CrowdStrike.
All right. This is good. All right. J.P. Morgan Chase, world's largest bank. I like them, but, I like Wells Fargo, more and more parts of that. Coterra is oil and gas, now more oil and gas. Hence, you see that stock just go exploding higher. Intuitive is one of the best medical device companies. I wish we owned it for the Charitable Trust. I missed it, focused too much on Abbott, but Abbott's working. Nvidia, we know, is Internet of Everything and semi of everything. I don't know. What do we call it? We should call it Renaissance. It's the Renaissance. Okay, where the world kind of changed in the Renaissance. And then CrowdStrike, cybersecurity company that happens to report next week. So we have cybersecurity, we have Renaissance, we've got bank, we've got oil and gas, and we have medical device. That is just absolutely perfect. And once again, if you've taken your cost basis out of even a speculative stock or any stock, I'm going to let it run, okay? Because you're never going to lose money. And the biggest sin in our business is to turn a gain into a loss. Now we're going to go another one of my favorite states. We're going to William in Kentucky. William, that's where Secretariat's buried.
That's right. Hey, Jim,
right.
This is Will from the horse capital of the world, Lexington, Kentucky.
Yes!
I think you're going to probably give me a hard time because I've got 5 names that are some way related to the AI revolution, but let's go to work. So okay. I've got 5 stocks: Adobe, Palantir, GE Vernova, SoFi, and Reddit. Thanks.
Is he diversified? Okay, GE Vernova, the stock is so hot, I can't believe it. At one point we thought it wasn't even going to be able to spin out because it had such a bad balance sheet. Now it's got a good balance sheet, but it's got the most momentum of any major cap stock in the market. We have Adobe, a software company. We've got Reddit, that's online publication. How about that? We got SoFi, that's Anthony Noto's brainchild. Not really, but he did come in and save it. And then Palantir, which is... Palantir is a sacrilege to call it anything other than the greatest company in the world, because that's what I heard the CEO tell me. But this is it's not really cybersecurity. It's more of a military web company with a consumer product tail. But we're going to call it cybersecurity. We're going to have publication. We're going to have bank. we're going to have software, and we're going to have, let's say, alternative energy. I don't want to call it all non-fossil because it's actually a really big natural gas company. Natural gas turbine company. So I'm going to say it's diversified. Again, this all have a tech component, but 27% of the S&P's got tech. I can't help it. Let's leave it at that. Mad Money's back after the break. It is time. It's time for the lightning round. Conversation by the three. Take your calls rapid fire. Say in the stock. I say to buy, sell, seller. Just be clear on the call. Stock questions at a time. My staff prepares the graph for the we play the sound. And then the lightning round is over. Are you ready? Ski Daddy, time for the lightning round. Conversation by start with Jane in Texas. Jane.
Hello there, Jim. How are you this evening?
I am doing well, Jane. How about you?
I'm doing really good.
All right.
I was wondering about the company BHT.
Well, you know what? That would be what I regard as being a hedge to the craziness that we're seeing right now. It's not like Bitcoin, which was a hedge, but now it's just pure speculation. Yields 5.6%. It is a very well-run company. I am blessing it with a buy. Let's go to John in Virginia. John.
Hey, Jim. Thanks for taking my call. I'm a huge fan of yours. Watch your show every night.
Oh, thank you, buddy.
You're welcome. My question is, should I hold or sell FANG? Diamondback
How about
Energy?
buy FANG? FANG is actually very, very good. And if you like the oils, it's a little more aggressive than the one we own for the trust, which is Coterra. I think it's well run. Travis Stice, good man. Let's go to Zach in Florida. Zach.
Hey, Jim. How you doing?
I'm doing well. How about you?
Doing great, sir. This stock I'm about to ask you about is near all-time lows. It has a few new revenue streams and has financed their debt to below what it was in 2019. With Hollywood bombs dropping in the foreseeable future, what do you think about the largest theater company in the world, AMC Theaters?
If it gets to 6, I want you to sell it. Period. End of story. Diraj in Pennsylvania. Diraj.
Hi, Jim Cramer. I'm a big fan. I'm a transplant physician watching your show 15 years. And consider you like a guru. You are like a blessing to all of us financially naive physicians. So I must thank you. My son just turned 1 year, so I wanted to buy a stock for him. I thought of a futuristic technology, Evolve, Joby. I wanted to pick your brain on Joby and obviously...
Okay, let me tell you. I actually am going to bless this. Let me tell you why. Because he's won, and you got all the years ahead of you. If you were to tell me within the next 5 years how Joby's going to do, I am going to be very uncertain. I think if it can continue to finance itself, then it will be able to make it out of here because it does make sense in a Jetson sort of way. So I'm going to bless it, but only for like a 20 to 30-year trade. Let's go to Jim in New York. Jim.
Well, good evening, Jim. Thank you for taking my call, first-time caller. I'd like to get your outlook on a company that I don't think some of your viewing audience has ever heard of, but it's been a good long-term play. I've had it for over 14 years, made over 2,000%. The 20-year return is over almost 4,000%, and it's split 7 times since '99. And it closed up today at over 10%. I'm talking about Copart.
All right, Copart I first recommended in 2000. In the year 2000 when I was at thestreet.com. It is a remarkable company because it provides vehicle supplies, and it is just unbelievable because they sell salvage vehicles, and that is what is needed. Now, I will tell you this. Because it just had a parabolic move from 50 to 62, I can't recommend it. I feel terrible with that, but I can't. I need to see a pullback in Copart. And that, ladies and gentlemen, is the conclusion of the Lightning Round. How much do I wish that every stock would turn out to be Nvidia, one of the biggest winners of all time? Wouldn't it be fabulous if so many of the money-losing companies I get asked about all the time could become the next Nvidia? I would love to rave about these names. I just wish I could. It's not going to happen. It's only one Nvidia, and as they say in law school, the rise of Nvidia is sui generis. So where does that leave the others, the companies you want to know about and think could make you fortunes? Are they all just lottery tickets that I refuse to bless on this show? And why am I thinking about this at all? Rocket Lab, that's why. I plowed through the introduction of the lightning round at 180 miles per hour. Crucial, though, and buried within that prologue are the words, quote, I do not know the stocks ahead of time, end quote. That's right, I really don't. but I do study thousands of stocks, and one of them is Rocket Lab. I study it because so many people just keep asking me about it. I know it's losing money, and that is a negative. I also know that anything space is incredibly exciting right now. When you have two of the world's richest people, Jeff Bezos and Elon Musk, duking it out to create the best rockets, you don't want to sneer at a money loser that happens to launch spaceships, provide launch services, and manufacture satellite parts because you're buying the picks and shovels of the space revolution. The company's creating its own rockets, too, and it successfully launched a reusable rocket. So where are the flies in the ointment? Why don't you say this could be the next SpaceX or Blue Origin? Price. That's why. Price. You see, Rocket Lab's up nearly 321% for the year. It's not like it's an undiscovered gem. It's a highly discovered, maybe overexposed even company. You can't just bless a stock with a chart that actually looks like a rocket ship taking off unless you can somehow justify its valuation. Even if it's got a great business model and amazing prospects, if the price is too high, I have to say forget about it. And by the way, rockets can explode, even the best of them. Now, I know that can be a bitter pill to swallow. I can hear some of you saying, hey, he bought Nvidia for his trust when it wasn't anything like the current Nvidia, and it grew into $3.5 trillion stock. Did it really matter if you first bought Nvidia at $20 and $30? Look, I know hindsight's 20/20. But you know what? It does matter. See, even if Rocket Lab turns out to be incredibly successful, will you still be in it when it reaches those levels? Think of it like this. You know I like SoFi at 15. It's been a real winner since $5. But has it been a real winner since 2021 when it traded at $25? I don't think so. How about if you'd bought it in the 20s when the NASDAQ was peaking in November 2021 and 1 year later it was at 5? Nobody sticks with that kind of loser. You don't get to the promised land. And that's what I fear. I want Rocket Lab to be as successful as this version of SoFi is now, but I cannot endorse a straight-up stock that could potentially go right back down. So excuse me for saying I'm not comfortable with a certain stock that you might like because I think the price is wrong. A stock that's going literally straight up is just as much a candidate to be the last SoFi, the one that went from 25 to 5, as it to be the next SoFi, the one that went from 5 to 15. Price does matter, people. You matter. I don't want you to get hurt. Which is why even if I love a company, I might not love the stock after a parabolic move. It might be better to take a breather, sell some, even ring the register on a piece of it. So if it does come back to earth, even for a short stint, you'll have some dry powder, you can buy some back. That way you can avoid turning the entire gain into a loss, which is a sin that I cannot countenance as long as I run Mad Money. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer, and I'll see you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.